Good morning, everyone. I hope you have all had a wonderful week. It's the Thursday of a short week, which for me tends to be a busier week than a long week. Today, I wanted to talk to everybody about some tax saving tips for mission-based business owners to reduce your tax burden and keep more of your money. If you are stopping by for the replay, or watching live, let me know where you were from and what kind of business you have. That'll help the algorithm keep this posted so that others can get some advice and tips. So I already said that. Once you're able to reduce what you pay in taxes ethically, you'll have more money to reinvest in your business in any way you see fit for growth. My name is Katie Brailsford. My business is KB Accounting. I have my MBA and with a concentration in accounting and over 13 years of experience helping mission-based business owners with their accounting needs. So let's get to the point. It's early. I want you to keep in mind that these are general tips and you should talk with your bookkeeper or tax professional for specific advice tailored to your situation. So the first thing that mission-based business owners could do is leverage tax exempt status. Many mission-based business organizations qualify for tax exempt status under the IRS code or IRS section 501c3. This could ensure that your organization, or first you need to ensure that your organization meets all of the qualifications, and that can make you exempt from federal income tax and provide opportunities for tax deductible donations from others. For example, imagine you run a business that focuses on providing educational resources to underserved communities. This mission would qualify you for a 501c3 tax exempt status. And you could not only avoid paying federal income tax, you could also attract donors because they could receive tax deductions for donating to your organization. The status can be a huge boom in your fundraising efforts. You can also document and deduct charitable contributions. If your mission-based business engages in charitable activities and donations and maintains meticulous records, you can often deduct these contributions from your taxable income. This includes cash donations, donations of goods and services. Just remember that the IRS has specific rules and requirements for these deductions, so you should consult someone who pays attention to that, who knows those ins and outs. For example, you host an annual charity gala. Make sure that you keep detailed records of all the donations that you've received, including the names, contact information, donation amounts. That is crucial when it comes time to claiming deductions on your taxes. It demonstrates the funds you received were intended for charitable purposes. So that'll prevent it from being an income to you. Instead, it's a donation for charitable purchases. Number 3, you can explore tax credits. Investigate available tax credits related to your mission. For instance, if you promote energy efficiency or renewable energy, you might be eligible for federal and state level energy tax credits. Additionally, research any tax incentives related to hiring and training disadvantaged individuals, which may align with your mission-based goals. So let's say your mission-based business focuses on promoting sustainable farming practices. You invest in solar panels to power your farm operations. You might be eligible for federal and state solar energy tax credits, which can significantly reduce your installation costs and ongoing energy expenses. These credits are incentives to support environmentally friendly initiatives. Now, if you went ahead and got your 501c3 status or a 501c6, it really goes to any 501c organization, not just the C3s, which I know, there I go, talking jargon again. Someday I'll do a training on the differences of all the 501c organizations. Anyway, you should plan for unrelated business income tax, or a UBIT for short. While mission-based organizations can enjoy tax exempt status, they may still be subject to unrelated business income tax, or a UBIT, on income generated from unrelated commercial activities. To minimize this tax, consider setting up separate entities for unrelated activities, or structuring your business in a way that maximizes exemptions under UBIT rules. So, for example, your nonprofit organization runs a thrift store as a source of revenue. The income generated from this unrelated business activity may be subject to a UBIT. To minimize the tax liability, consider separating it into a for-profit subsidiary to handle the thrift store operation. This way you can maintain your tax exempt status for the core mission and activities while addressing the tax implementations of the unrelated income. Remember that these are general knowledge tips, and they may not apply to every specific situation. Tax laws are complex and can change, so it's essential to work closely with a tax professional who understands your mission-based business and can provide tailored advice. Look, so many mission-based business owners are leaving tens of thousands of dollars on the table because they're ignoring the importance of planning ahead. That doesn't have to be you. If you don't have a team to support you with your cost reduction techniques, please feel free to reach out to us so we can see how we might be able to help. Also, if you know a business friend who might need to hear this information, please share this video with them or tag them below to help get the word out. And let's see if we can help save people money. I mean, that's always a good thing, right? I hope you all have an amazing day. I hope you all have a great rest of your week, and I will see you all next week. Bye, everyone.